All right, welcome back to another video. We're going to try to do more of the videos corresponding to the newsletter. Compliance review is a little backed up, so we've had to not do the videos for a little bit, but we're going to get back into the groove of some of these videos. So it is March 6th. I know there's a lot going on in the headlines, obviously, in the world right now. Um, so we're going to address volatility and long-term retirement planning or long-term portfolio planning in the next couple of videos. But we can't necessarily pivot right now because this this script is already approved through compliance, and so um, what we want to talk about is this tax window that shows up early in retirement. With it being March, we're heavily in tax planning season or tax filing season, 6 weeks left. But we need to talk about this tax window that opens up for early retirees that sometimes goes missed. And so, what ends up a lot of times is we go through our year and we go to file taxes and we think about how do I pay less taxes this year? And so there's not necessarily anything wrong with that, but minimizing your taxes should be looked at over a longer period of time, sometimes 5 to 10 years, where you can take advantage of this retirement window that pops up between when you stop getting a paycheck and when you have to start taking required minimum distributions out of your pre-tax accounts. This window opens up that you can do some major tax planning. And so we're going to talk about this window. And so to kind of help start thinking about these things, if you're either preparing for retirement or still early in retirement. And so your earned income stops. So your salary, your bonuses, all of that comes to a halt. And so what ends up happening is that your taxable income becomes much more flexible. And if you haven't claimed Social Security yet, this window opens up before requirement of distributions where you can control your income from all the different income sources you might have. You might have pension, Social Security, your pre-tax retirement, your tax-free retirement and Roth, or anything outside of your retirement accounts, savings sometimes. And so you can start to create in this tax window, start thinking about a tax strategy to where you can minimize your taxes, not just in the year that you're in, but over the course of this 5 to 10 year window you might have. And so once RMDs start, the flexibility shrinks because whether you like it or not, or whether you want it to do it or not, the IRS forces you to start taking money out of your retirement account, your pre-tax retirement accounts. And so the control over your income starts to erode. And so you turn on more of your Social Security could be taxable. Your Medicare premiums could go up. There are surcharges. And so just more of your income gets pushed into the taxable bucket. And so the levers that you have become smaller once you hit required minimum distribution. But up until that point, there's strategies you can do to reduce your RMDs now or your future RMDs, paying taxes now to do that. And one of those ways is through a Roth conversion. And so Roth conversions allow you to move money pre-tax into after-tax Roth, pay the taxes on it now, let that money grow tax deferred for later use, but ultimately drain down your pre-tax, even though the IRS is not forcing you to do it. And ultimately, you can try to optimize your taxes during this tax window. And so the math doesn't always favor it. Again, this is educational, so everyone's situation is different. So it's not necessarily a recommendation. But there are four different things you can ask, four different questions you can ask yourself in this retirement window that can help figure out whether or not this strategy is good for you. And so one of them is, when do I need to take required minimum distribution? This age may change in the future, but you need to figure out when that is, what year that is. You need to take it in the year that you will be or turn that RMD age. Figure out when that is. Two, when am I planning on taking Social Security? Some people might be taking it right away. There's all different types of reasons why you would take it now or wait. But again, wanting to know when that is. Okay. And then, what does your taxable income actually look like? And what I mean by taxable income is what will be bringing in that you actually have to pay taxes on. So that could be your pre-tax money in your IRAs. It could be capital gains with after-tax money or your investment account, savings, interest, all of the things you have to pay tax on. But what does that look like? What does that number actually look like? And what are the sources? And then four, have you ever looked at a multi-year tax model to actually draw out what taxes will look like over multiple years? I think what a lot of people fall into is this, hey, it's late March, early April. How did we do? And they go back and go, oh man, we didn't do well. We owe, or our refund is lower, or whatever the scenario may be. This is a way to start projecting your taxes over longer periods of time to optimize what you can do and get money, or where your sources of income are from, and put together the best strategy for yourself over the long run. This 5 to 10 year window that happens slowly closes quietly. And it doesn't necessarily mean there's a lost opportunity, there's just lost inefficiencies there. And so taking a look at this window and being more cognizant of your tax planning over the long run help make your tax plan more efficient over multiple years rather than just looking at it year by year by year. Hopefully, these financial concepts help open your eyes to all of the possibilities in retirement. If you want more information like this, please subscribe to our channel as we continue to push out more videos and newsletters as time go on. We'll see you at the next video.